Hey everyone, welcome to This Explainer. Whether you're actively managing a portfolio right now or just looking to refine your financial mechanics, today we're stepping back to look at the absolute fundamentals of making money in the stock market. We're going to strip away all that complicated jargon and look at how wealth is actually built.
Look, the fundamental question we all ask is pretty simple. Is it really possible to sustainably grow your wealth? I know the market can sometimes feel like this exclusive club for financial experts, but today we are completely demystifying the actual mechanics. We're breaking down the data in straightforward terms so you can see exactly how this whole system operates as a tool for financial growth.
Here's our roadmap for today. We'll be looking at 1. What the stock market is, 2. How investors actually make money, 3. Smart tips for beginners, and 4. Costly mistakes to avoid. Okay, let's dive right into this. Section 1. What is the stock market? The basics of buying and selling. At its core, the stock market is really just a marketplace where people buy and sell shares of companies. That's it. Instead of trading everyday consumer goods, you're trading fractions of real operational businesses. Think about it this way. When you hit buy on a share, you aren't just getting some digital number blinking on a screen. You're actually becoming a partial owner. You hold a distinct fractional stake in that company alongside millions of other investors. You are literally acquiring a piece of that enterprise. And because you're an owner, your financial success is directly tied to the business's success. If the company innovates, if it expands and crushes it in their industry, the underlying value of your fractional ownership increases right along with it. It's this direct link between the real-world performance of a business and your personal equity. Moving smoothly into Section 2, How Investors Make Money, the 3 Paths to Profit. When you strip away all the complex Wall Street trading strategies, there are exactly 3 primary, common-sense ways investors actually generate profit. Let's look at the first 2. First step is capital gains. This is buying shares at a lower price and selling them later at a premium. The difference between those 2 numbers, that's your profit. Second, we have dividends. Instead of requiring you to sell your shares, some companies actually distribute a portion of their cash profits directly to you. They are rewarding you simply for being an owner. The third path is long-term investing. By holding on to quality stocks over an extended horizon, you unlock the absolute magic of compounding. As your investments generate returns, leaving those returns in the market allows them to generate returns of their own. It scales your wealth exponentially over time. Let's get into the practical stuff. Section 3, Smart Tips for Beginners and Building a Solid Foundation. Building a solid foundation really relies on 3 core rules. First, start with companies you actually understand. Knowing a company's business model gives you a huge analytical edge. Second, always research the underlying data before you buy. And third, diversify. Spread your capital across different assets so if one company underperforms, it doesn't sink your entire portfolio. Now, what's really interesting about this slide is the stark contrast in mentalities. Choosing the patient, compounding approach is how sustainable wealth is built over time. Treating the market like a fast-paced, get-rich-quick scheme is conversely one of the absolute quickest ways to lose your capital. I want to slow down for a second for this one because it's a vital safety rule. Only invest capital you can afford to lock away. Markets fluctuate, so you need the financial flexibility to leave your portfolio completely untouched during a downturn. Never invest your daily living expenses, because being forced to liquidate during a dip just locks in those losses. Which brings us to Section 4, Costly Mistakes to Avoid and Protecting Your Money. Don't invest based on rumors or social media hype. In today's digital age, the pressure to chase those viral trends is just immense. But abandoning fundamental research to follow crowd hype is pretty much a mathematical surefire way to make costly errors. You've also got to master your own psychology. Avoid decisions driven by fear during a market dip or greed during an artificial spike. Don't expect guaranteed profits, and always remember that stock prices inevitably go down as well as up. These fluctuations are just the reality of the market, and expecting a straight line of profit is only going to lead to panic. When we bring all the source material together, we find a highly effective formula for long-term wealth. Understand the foundational mechanics, practice extreme patience, and invest consistently. Sticking to this straightforward equation tilts the odds of success heavily in your favor.
Finally, it's really essential to set realistic boundaries here. As the source material reminds us, this is for educational purposes only. All investments involve risk, including the possibility of losing money. Recognizing that risk is truly the first step to managing it effectively.
I want to leave you with this final thought. We've explored the mechanics of capital gains, dividends, compounding, and the dangers of hype and emotion. But the ultimate variable in this entire wealth formula is you. So, are you ready to be patient? Thank you so much for joining me for this explainer, and I will see you next time.